Introduction: the illusion of safety. For most of the last century, standard investment advice has sounded pretty simple. Minimize risk, spread your money across lots of assets, buy and hold, and play it safe. That worked well enough in a slow, predictable world. But the economy you're living in now is anything but slow or predictable. In a landscape this volatile, that version of safety can quietly become the biggest risk in your portfolio. It can drag your wealth down slowly through inflation or leave you fully exposed when the next shock hits. Welcome to the Rational Risk. Here, we don't treat markets like a force of nature you have to endure. We treat them like an environment you can design your exposure to. Real, durable wealth doesn't come from avoiding risk altogether. It comes from understanding which risks you're taking, what they cost you if you're wrong, and what they can pay you if you're right. In this episode, we're going to dig into one idea that quietly sits behind almost every great fortune: asymmetry. Small, controlled downside. Large, open-ended upside. If you risk $1 to potentially make 10, you only need to be right roughly 1 time out of 10 just to break even. Anything better than that, and the math starts working hard in your favor. This is the lens we'll use to look at the 2026 economy. The math of asymmetry, why most investors fail. Let's put some simple numbers on this. Imagine a setup where every time you invest $1, there's a realistic path to making 10. You won't win often. You might be wrong most of the time. But if you structure it correctly, you don't need to be right very often at all. With a 1 to 10 risk-reward profile, a hit rate of around 10 to 11% gets you to break even. Anything above that compounds. This is what an asymmetric bet looks like. A clearly defined limited loss if you're wrong, and a much larger uncapped gain if you're right. Now, compare that with how most investors behave in the real world. They effectively risk $10 to make 1. They pile into whatever is popular and expensive, tell themselves they're investing for the long term, and then watch their portfolio get hammered when the cycle turns. Fear of missing out and herd behavior quietly drive most of their decisions. The downside is large and vague. The upside is small and often capped. Our goal is not to avoid risk. That's impossible. Our goal is to choose our risks carefully, to know in advance what we can lose, and to insist that what we might gain is many times larger. When you do that repeatedly, you tilt the long-term probabilities in your favor. That's how you move from "I hope this works" to "the math is on my side." The 2026 economy, a landscape built for asymmetry. 2026 isn't just another date on a chart. It's a moment where several big forces collide at once. Stubborn inflation, fragile supply chains, political tension that can move markets overnight, and a wave of technological change that keeps speeding up. Entire industries are being redesigned instead of tweaked. New ones are appearing out of nowhere. In that kind of world, owning a broad slice of everything and hoping it grows is no longer enough. It keeps you exposed to all the downside of the old system without giving you focused exposure to where the real upside is growing. Inside that chaos, though, there are pockets where asymmetry is built into the structure, places where the downside is anchored by real, persistent demand, and the upside can expand as technology and adoption catch up. In this episode, we'll look at 3 of those sectors in particular: decentralized energy, precision agriculture, and personalized medicine. Each of them has a different story, but they share the same core feature: clearly limited downside and open-ended upside. Sector 1, decentralized energy, the resilient grid of tomorrow. Start with energy. The old model was simple: a few huge power plants, long transmission lines, and a grid that assumed everything would keep working most of the time. We now know how fragile that setup really is. Cyber attacks, extreme weather, and political decisions can all take large chunks of that system offline. The emerging model looks very different: microgrids, rooftop solar, local storage, and networks that let homes, businesses, and communities both produce and consume power. From an investor's perspective, the downside in this space is naturally limited. Electricity isn't optional. It's a basic input to almost everything else we do, and governments around the world are spending heavily to make energy systems more resilient and less dependent on a small number of central nodes. That spending and that demand put a floor under the sector. The upside comes from the technology curve. Advances in batteries, solid-state storage, AI systems that balance and predict demand, and new forms of generation all stack on top of that baseline need for power. If we move from a world of passive consumers to energy prosumers, people and communities that produce, store, and trade their own energy, the value created doesn't scale in a straight line. It can grow very quickly once the infrastructure is in place. In practice, that means looking at companies and projects building microgrid hardware and software, next-generation storage, and platforms that make local energy markets work. You're not just betting on sun and wind, you're betting on the entire system that lets energy become more distributed, flexible, and independent. 5. Sector 2. Precision agriculture and vertical farming, feeding the future. The second sector is food. The global food system is under pressure from several directions at once. More people, less predictable weather, water stress, and soil that's been pushed hard for decades. Traditional methods are struggling to keep up, and simply planting more of the same crops in the same way isn't going to fix that. Precision agriculture and vertical farming are two responses to that pressure. Precision systems use sensors, data, and AI to decide exactly when and where to water, fertilize, and protect crops. Vertical farms move production indoors into tightly controlled environments where light, temperature, and nutrients are all tuned. The key point is this: people will always need to eat. Food demand doesn't disappear in a downturn, and over time it grows. That persistent demand caps the downside. Technologies that make food production more resilient to climate shocks and less dependent on long supply chains have a built-in reason to exist. The upside shows up in efficiency. Vertical farms can use far less water and land than traditional fields and grow all year round. Precision agriculture can raise yields and cut waste. As these systems scale and improve, the gap between old way and new way widens, and the winners can become very large, very fast. Here, asymmetric exposure might mean backing companies working on controlled environment agriculture infrastructure, farm robots, crop monitoring drones, and seed lines designed specifically for these new growing conditions. You're not just buying into a story about agriculture tech, you're choosing businesses that sit where necessity, efficiency, and technology overlap. Sector 3. Personalized medicine and diagnostics, the proactive health revolution. The third sector is health. For most of modern medicine, the pattern has been simple: wait until something goes wrong, then try to fix it. That approach is expensive, reactive, and often too late. Personalized medicine and advanced diagnostics flip that script. Instead of treating everyone the same way, they use your genetic code, your physiology, and your data to tailor interventions before problems become crises. Here again, the downside is anchored by something very basic. Healthcare is not discretionary. As populations age, demand for effective treatment and prevention rises, and very few people willingly cut essential care if they can avoid it. That reality sets a floor under the need for better medical tools. The upside comes from what happens when you can see disease much earlier and treat it more precisely. Imagine being able to reliably catch certain cancers years before symptoms appear, or to adjust therapies based on how your specific biology responds, rather than on broad averages. Genomic sequencing, AI-based image and signal analysis, targeted drug delivery, and gene editing all aim at that kind of shift. In portfolio terms, that can mean backing companies working on precision biotech, AI diagnostic platforms, and secure genomic data infrastructure. This isn't a small niche. It's a slow, grinding redefinition of what healthcare is: less crisis management, more ongoing maintenance and optimization. Conclusion: engineer your wealth. We don't have to accept whatever mix of risks the market hands us. We can choose where our downside is tightly controlled and where our upside has room to run. Decentralized energy, precision agriculture, and personalized medicine are 3 examples of sectors where that asymmetry is built into the structure of the opportunity. Clear, persistent demand on the downside. Open-ended potential on the upside. If you start viewing your portfolio through that lens, small, known losses versus large, plausible gains, you stop chasing every new narrative and start designing your exposure with intent. In the next episode, we'll take this a step further and look at the Kelly criterion, a framework for sizing your bets so the math of asymmetry compounds in your favor over time. Until then, think clearly, choose your risks on purpose, and keep engineering your own edge.